Hi, welcome to Community Living. My name is Mala Mungosi, and in today's episode, we'll be covering unit trust. So, a friend of mine recently took out a unit trust with Stanlip, and that was under like the advice he received from his financial planner. So he has a young professional banking account with a Standard Bank, whereby I think when he just went through his like investment goals and savings and all things related to financial planning, he was advised to take out the unit trust with Stanlip, right? So when he told me that he would like to find out more, the first thing I said, how is it that he is invested in this investment vehicle but he doesn't understand how it works? It's very important to understand how your money makes money on your behalf, right? Hence we're here learning so that we actually understand this investment vehicle, so we know that they're actually going to do what they're supposed to be doing for our investment journey, financial journey, savings journey, whatever journey that you're going through related to your money. You need to understand what is happening there, right? So I'll be using an executive summary approach where we'll just be going through what exactly is it, how does it work, and all those things, right? So the first part of this will actually just be going through the definition and the characteristics of a unit trust. So a unit trust can be seen as a collective investment scheme where the funds are pooled by various investors in this collective investment scheme, so that they can be able to invest in various asset classes or asset types. And another biggest characteristics of a unit trust is that it has a fund manager. So the fund manager is known as someone who has the expertise to run this fund and actually maximize the performance of the underlying assets that I've already mentioned. The underlying assets could be shares, bonds, property, cash. So in order to ensure that the portfolio or the investment vehicle performs in such a way that the return on investment for the investors is really high, right? Another thing that is interesting about unit trust is that there are about 1,000 to 1,200 unit trusts in South Africa, just South Africa on its own, right? So each and every unit trust has its own mandate, or what we'll call an objective and purpose, right? So that objective and purpose needs to be aligned with your investment objective, right? So let's just say you want an investment vehicle that will look into growth, right? The type of growth where at some point you will be cashing into that investment vehicle and receiving the funds. Then maybe you'll go for a capital growth investment. But if you're looking into maybe passive income, you'd go for a unit trust which meant whose mandate or focus is on those type of asset classes or those type of outcomes at the end of the day. So how you choose a unit trust is based on its mandate, its core mandate, and also each unit trust will look into things like risk profile, right? It also look into minimums that you need to pay on a specific month or date, or whatever it is that the unit trust is set up like. So you have to ensure that you understand the inner workings of that unit trust to say that, okay, if they're saying the minimum is 500 rands per month, I can afford to fork out 500 rands per month because I have ensured that whatever money that I receive, I will be able to fork out that 500, because there might be penalties to not being able to do that, because sometimes especially with like a recurring investment, right? And then also there's an option of maybe contributing a lump sum to it. So maybe you're contributing like 10k to this unit trust, and then for the entire year or for however long, you don't have to put in any amount to the unit trust. And there are sometimes some unit trusts which offer you the flexibility of both options, where you could have a lump sum plus a recurring investment type of setting, right? So you need to look into all those things. And as I've mentioned, there are minimums to this. So some unit trust could be like the minimum lump sum, it's 10K and above, right? And then some in the unit trust would be like, okay, the minimum is 10 rands per month, right? So I've heard about Coronation, where you can invest as little as 10 rands in a unit trust and still be able to gain from the benefits of having this collective investment or pooled funds, right? So, and it's also important to understand that the fund manager is of utmost importance to this. So that's what differentiates a unit trust from a passively managed fund like an ETF, right? So another question is, why would you consider it, right? Since I've already mentioned it, you have someone who's running this fund, someone who has the knowledge about the various asset types, has the knowledge about the mandate, and has to ensure that the investment vehicle is steered in towards that mandate, right? So whatever investments are made is to ensure that that mandate is met, right? And then usually it promises a return on investment that is higher than most money market funds. So you'd find between 10 and 16% for like some of the unit trusts. It's not all the unit trusts, but another thing that you must be wary of is that the amount is not guaranteed. Just like any other investment vehicle, you're not guaranteed any amount. It's just that these are amounts that are based on past performances, right? So, and another thing is the ease of access or liquidity of the funds. So you are able to cash in at any time without having to wait like a long time, or without the restrictions. Just like maybe if you have a retirement annuity, you can only cash it in when you're 55, but with a unit trust you can cash it in any time that you'd like to. Obviously there will be terms and conditions when it comes to penalties, cancellation fees, and all those things, but those are the things that you need to find out before you get into a unit trust, so that you know what will be the procedure, what will be the fees, and so forth, and that you're not caught in the dark whereby you lose some of your some of the interest that you've earned because of maybe cancelling too soon or something of that sort, right? So now we will be looking at the advantages and disadvantages of a unit trust, right? So some of the advantages that it's tax efficient compared to a money market fund. So with a money market fund, you pay like in the case that you're making a lot of money, right? If you exceed more than 23,800 per annum, you're taxed 40% above that amount, right? So, but then with a unit trust, it works just like the underlying asset, whereby you're charged on the capital gain tax. So it's after 40,000 of that capital gain tax. So it's tax efficient. And then I've already mentioned the affordability and the accessibility, right? So it's sometimes being able to invest as little as 10 rands per month obviously makes it a very affordable investment vehicle or investment product. And also it gives you the diversification that you might not attain when you're investing in like the stock market on your own, and especially if you're like a financial novice and you don't really understand what is happening with the various shares and various ETFs. So it protects you from such things. So, and another thing is that there is a level of safety attached to it because of how it is set up, where you have the trust company and then the trustees and the investors involved. So there's a level of safety net that is provided by having a unit trust, right? So another thing is that it gives you access to the stock market even though you do not have any type of knowledge regarding the stock market. And I think as much as I like that advantage, I am very much like against how it is structured, right? You must understand how your unit trust actually works. You must understand that, okay, if they're investing in this and this and this and this and this, these are probably the projected returns, and you kind of can gauge what your fund manager is doing. So as I've already mentioned, that the returns are not guaranteed. So if you can see that, okay, maybe your fund manager is not doing things that will lead to a high performance, obviously you can contact them to find out more about the fund. But since you're not the only person that is investing in that pool of funds, your voice is sort of like doesn't really count to an extent, because it's the voice of the majority that counts, right? And some of the disadvantage is that just like any other investment vehicle, time is a factor, right? So if like the stock market is volatile, so if you're going to invest in just for less than 3 years, or let's just say less than 5 years, you will feel the volatility of not having invested for more than 5 years, because we know with the stock market you start seeing higher returns if you've invested for more than 5 years. But in a period that is less than 5 years, you might have had a good like a good performing investment portfolio, or a really bad performing investment portfolio. So another disadvantage is that it's not really, as much as there's a fund manager who has the expertise, that does not mean that anything is guaranteed, right? And the fund manager is also not liable for any losses that you might incur as a result of investing in this investment vehicle. And also you still have to pay things like security tax and dividend tax. Well, the entire unit trust still has to pay those things. So those are some of the costs that the unit trust will have to incur. So another disadvantage of the unit trust is that there are too many costs, and the costs are not as transparent or as visible. So you have things like performance cost, right? Whereby the performance cost actually is in favor of the fund manager over the actual investors of the unit trust. So you must be wary of those things. And the average cost for like just investing in most unit trust is at least 1% of whatever you've invested on a yearly basis. So depending on how much money that you are having in your account, it can also lead, like it can be between 1 to 5%, like the cost of investing in a unit trust. So you find that you're paying up to 5 rands for every 100 rands that's in your unit trust. So you must be wary of that, because there are other cost effective solutions or investment vehicles, such as ETFs, where you find that the total expense ratio is as little as 0.19%, right? So, and it's a passively managed passively managed investment vehicle, whereby you don't have to pay anything to the fund manager, right? So remember that because there's a fund manager, that fund manager still needs to be paid a certain amount, which will come from the investment that you guys are contributing on a monthly basis or on a yearly basis, or whatever the time frame or time factor that is put into that unit trust. So yes, I hope you learned quite a bit about unit trust, and next time that you're thinking of taking out any type of investment vehicle, you actually do the research, you actually understand how you're going to make money from that investment vehicle, and how that investment vehicle actually works. So, and compare it against other investment vehicles as well. So thank you for joining today's episode.